this point, allow me to introduce Dr. Murithi Ndegwa so that he can give us his opening remarks and also give us an introduction of the speaker. Karibu Idi.
Thank you very much, Brian. Good afternoon, everyone, and thank you also for joining us for this webinar. And more so, Mr. Nelson Ogara, thank you for coming on board and coming early. Now, the topic, as Brian has said, is demystifying tax and pitfalls to avoid. But firstly, allow me just to make some few brief remarks in our perspective about what it means to demystify tax and pitfalls to avoid. We believe that there are various types of taxes in Kenya today, and I'm sure Nelson will be talking quite a lot about that, including corporate tax, income tax, withholding tax, pay as you earn, capital gains tax, minimum tax, etc., etc. And whether one is in business or in employment, we believe that it is important to arm yourself with the correct information about tax compliance. This, in our view, will help to avoid unnecessary mistakes. Some of the mistakes that we've come across include making a wrong choice of structure, for example, business structure, when registering. And a business may start off as a sole proprietorship, but as it grows, it may require change of its legal entity or status. And at this point, it is important and it's always advisable that one engages an expert for professional advice about its structure and the requisite tax implications. We also know that it is a mistake to evade tax or to even undervalue your income. Tax evasion in this country is not only considered a crime, but it also hampers your business. And in our view, it's standing in the society in general. And we believe it can lead to imprisonment or even penalties or both. Late filing of tax returns or not filing at all, again, is a pitfall that we have come across, and it can cost one penalties in the future. But I'm sure Nelson, who is an expert in this area, will delve much more deep in terms of explaining what this is all about. So in our view, we believe that it is prudent to file one's taxes on time and as per the requirements. And in our considered view, therefore, it is important to keep one's accounting and financial records up to date and correctly done. And this, we believe, will help the business to ascertain the amount of tax it owes to the government. Today, we're privileged to have Mr. Nelson Ogara, who is a tax director at PricewaterhouseCoopers. He will be tackling the topic, demystifying tax and pitfalls to avoid. And we believe that he will certainly give us insights on this fascinating area, yet a very less understood topic. So Nelson, we believe that you'll give us a good discourse in this topic that is of interest to many of us. And we therefore we'll look forward to, after Nelson has given us his discourse, that we'll all have a changed mindset about taxes. Even in the Bible, we know the tax collectors were really hated people, but I think we need to change our mindset so that we do not necessarily hate them. We do not necessarily hate the whole aspect of taxation or tax business, and we embrace it. And like Arthur Vanderbilt once said, he was a famous American judge and judicial reformer, and I quote, "Taxes are the lifeblood of government, and no taxpayer should be permitted to escape the payment of his just share of the burden of contributing thereto." Very nicely put. Finally, before we invite Mr. Nelson Ogara, allow me to just mention briefly about the KIM highlights for the activities that we are going to be having in the next couple of days or weeks. First and foremost, the KIM membership renewal is ongoing, and we appeal to those who have not renewed their membership for this year to please do so. You not only enjoy the benefits of participating in the webinars, we also endeavor to send you all the past webinar presentations, and we've had webinar presentations for more than a year. You can pay your subscription either through the pay bill number that will be displayed on the chart, number 896600, and your account number is your membership number, or you can make inquiries through telephone number 071 22 00969. I read 0712 200 969. You can email kim.ac.ke. The details will be posted on the chat as you go by. Again, also in KIMSOM, that's a KIM School of Management, we are still conducting diploma and certification courses, and we appeal to all of us who have children or who have working people who want to professionalize their courses. Please register for the diploma or certification. A wide range of them. We have a variety of them, and details again will be put on the chat. Finally, we have a number of upcoming programs. This is in training and conferences. And first and foremost, we have fleet management, which is running from 7th to 11th in Mombasa. We also have asset disposal training program running from 14th to 18th in Mombasa. We also have cybersecurity policy development workshop for ICT managers, again, also running from 14th to 18th in Mombasa. Then you have the effective office management and administrator program, TMOP module 1, running from March 21st to 25th, again in Mombasa. And then we have a very exciting program coming on board called the Executive Leadership Program, which will be held from 21st to 25th of March 2022 in Dubai. This would be very ideal for corporate executives, those who are aspiring to join the C-suite, board members, etc., etc. And we request that you please register for it. Again, the details will be posted on the chat. And for more information, you could also call us on 077 33 592 78. I read 077 33 592 78, or you could email training@kim.ac.ke. And for more details, again, you could also visit our website, www.kim.ac.ke. Please feel free to interact with us on the chat as the program goes by, because we'll post a number of details in regard to these programs. Thank you. Now, it's my pleasure and my privilege to invite our speaker. Our speaker is none other than Mr. Nelson Ogara. Nelson Ogara is a tax director at PricewaterhouseCoopers with over 20 years of experience in providing tax advisory services to local high-profile companies and multinational companies. So Nelson's experience covers all aspects of tax, such as corporate income tax, VAT, PAYE, and customs. As an experienced tax professional, Nelson's role involves providing strategic tax planning for PwC's clients in an effort to optimize on tax efficiencies and thereby enhance shareholder value of the entity. He has led tax due diligence assignments, tax reviews, providing support to clients in managing tax audits by revenue authorities, and advising clients on creating effective tax functions. Nelson has also worked in Rwanda as the head of tax for a period of 8 years and was part of a pioneering team that set up the PwC office in Rwanda. During his time in Rwanda, Nelson played a key part in creating a sustainable tax business, and he was also involved in the development of staff, implementation of processes, interaction with the market and regulators, business development, thought leadership, including participation in the Ministry of Finance Policy Committee, national budget events, TV appearances, media articles, and head of firms, tax, and regulatory compliance. Currently, Nelson specializes in providing tax reporting and strategic services to our clients. Nelson is a regular presenter on tax issues and has appeared on CNBC Africa and Rwanda TV, commenting on regional tax changes. And Nelson is also part of PwC's budget team that analyzes the Kenya national budget each year. Nelson holds a Bachelor of Commerce degree from the University of Nairobi. He's a CPAK and a member of the Institute of Certified Public Accountants for Kenya and Rwanda. Ladies and gentlemen, as usual, if all is well, please give us a thumbs up. If there's a problem, give us a thumbs down, or post whatever issue there may be on the chat, and we'll endeavor to resolve it. Nelson, the floor is yours. Welcome on board to give us the discourse on the topic of today. Thank you, and karibu sana.
Thank you very much, Dr. Muridhi Ndegwa, CEO Kim. Thank you for such a really good introduction. So thank you very much, and I want to take this chance to appreciate Kim for inviting me to present today on this very engaging topic. And I think the CEO, you really captured the aspects spot on. I liked what you mentioned, a quote of tax being the lifeblood of the government. And we are going to see that and how just it fills in the importance of complying, the risks of evading tax. So we are going to touch on those today. Kim is a respected brand, and your impact in promoting excellence and integrity in the practice of management is unparalleled. And I'm quite very delighted to be here today. I also want to appreciate distinguished members of KIM who are joining today on this topic of demystifying tax and pitfalls to avoid. As Dr. Ndegwa mentioned, I work with PwC and I've worked there for 20 years. So today I'll be sharing just from my experience, what have I seen? And essentially being at the ground, I've dealt with clients, both high profile clients, multinational clients. I have dealt with the Revenue Authority, both here, Kenya Revenue Authority, and also Rwanda Revenue Authority. While in Rwanda, I had an opportunity to train the officers of Rwanda Revenue Authority. So that gave me quite an insight on what the Revenue Authority, from the Revenue Authority's perspective. And I hope as we engage that today you'll hear something new that you are not aware of that adds to your knowledge. So essentially that's our agenda, just a brief introduction. Then before we dig into really tax, just paint a picture of the Kenyan landscape, tax landscape. Where are we? What is really the policy direction? Then I will run through the various taxes that we have. The CEO mentioned about the taxes that we have. So I'll give you a snapshot. I want to mention that tax is really wide. Normally when we do training, VAT alone will require a whole day. So you can appreciate that today we're just giving a snapshot and condensing all this. Then I'll touch on some topical issues. What happens if you don't comply? What is KRA doing now? We heard from the introduction about that there are actually penalties, very huge penalties. Some even include jail terms. So we look at that. And then finally, I'll touch on habitual tax mistakes that companies make. What have we seen as we engage with companies? What are the mistakes? What are the gaps? The CEO talked of the need to engage the profession. If you don't engage the profession, professionals, what is happening? What will be the cost when you are saving that money versus the non-compliance cost that comes in? Is it comparable? So again, we had I don't know, the CEO, you had the insight on my talk. We had about just attitudes towards tax, when you see, you remember in 1969, Americans were rejoicing, taking someone to the moon, having a person landing to the moon. And there's a viral quote that went through whereby somebody said that if there are people to be taken to the moon, it should be the tax collectors and they should be abandoned there, just reflecting the attitude that people have tax. Dr. Ndegwa talked about the tax collectors and how they were hated. And again, a quote from the Bible, for those who read the good book, Jesus talked of a parable. And in this parable, two men went into the temple to pray. One was a Pharisee and the other was a despised tax collector. The Pharisee stood by himself and prayed this prayer. I thank you, God, that I'm not like other people, cheaters, sinners, adulterers. I am certainly not like that tax collector. I fast twice a week and I give you 1/10 of my income. And you can just see the attitude of how it's not really something of 1969. It's something that began for a long time. And I don't know today, as you are attending here, I know we have quite various people, categories. I don't know what's your attitude towards tax collectors, towards Kenya Revenue Authority. I don't know what experience you've had. And I mean, for us talking with clients, most of them have diverse experience. Some have really very nasty experiences. Some bit kind words if they put their affairs in order. But I think tax is important. We talked of tax being the bloodline of government. I just wanted to give us a snapshot before we dig into today's topic. If you look at Kenya and you look at the tax to GDP ratio, as at 2019, the data that we have, our ratio coverage was 17.3. And if you see the green covering, it's been rising and going up. So meaning that we have done very well. We've done very well as a country. If you compare us with our neighbors, ours is better. I know Rwanda is 15.3%, they just fund 60% of their recurrent expenditure. Kenya, we've been doing well into close to the 90s. So the tax that is being collected is actually supporting us, helping us as a country to see how we manage. Just a quick snapshot. If you look at Kenya, 2010 to 2011, and look at it to 2020, 2021. By 2011, 2012, we were collecting close to 700 billion. So 0.7 trillion, that's trillion. But by 2021, we collected close to 1.5 trillion, 1.6. So we've doubled in 10 years. The growth has been massive. So it means something is really happening. Our revenue authority is demonstrating that they are very much efficient, one of the most efficient revenue authorities in collection, and we can see that growth. So I want us to look at, just as a foundation, to put in some foundation and benchmark in terms of looking at what is really the policy trend. And what I'm sharing here is driven from our budget policy statements. And also last month, we had a privilege where we had the Principal Secretary, National Treasury and Planning, Dr. Julius Muya, attending PwC Africa's Virtual Tax Policy Conference, in which he gave us a snapshot. So in a way, we are talking actually from the horse's mouth in terms of what he shared. So one of the focus is the government is looking at broadening the tax base. And from there, we've seen a number of tax exemptions being reduced, being overhauled. When you look at VAT, some of the exemptions have been reduced. We had a number of companies in the manufacturing sector that were enjoying some of the exemptions. Those have been reduced. We heard of the voluntary tax disclosure program. Last year, the claim for voluntary tax disclosure was 100% waiver of penalties. And taxpayers who benefited from that, they came clean, cleaned their affairs, and enjoyed that exemption. We've had the taxation of informal sector, and we are going to talk about turnover tax and how it's simplified. There's also been introduction of minimum tax. This was to target those companies that are in loss position. And what the government is checking and asking is that you've been operating here for the last 10 years, you are in a loss position. Why are you not contributing to what we have? We've also had the digital services tax to target those non-residents who are trading and sourcing income from Kenya. So there's a big agenda towards broadening the tax base. We've also had the modernization of tax laws, and we've seen quite a move towards this. We've had a new laws. In 2015, we had Tax Procedures Act. We've had Excise Duty Act. We've had Tax Appeals Tribunal. The Tax Appeals Tribunal has quite revolutionized the dispute resolution process, just making it much more smoother so that tax matters can be resolved quickly. And in a short while, we'll be looking at what are the stages of the appeal process. If you have appeal process, then how do you go? We've also had the benchmarking where Kenya wants to ensure that our laws comply with international best practice. So you'll find references to the OECD. They look at UNO-based convention. There's the African Tax Administrations Forum that looks at a number of issues. The fourth one is just collaboration. So there are a number of multilateral agreements such that if you are a multinational operating in Kenya and there's a need to look at your affairs to really confirm what you are disclosing, then Kenya Revenue Authority can actually write to your home country and seek this. We've also had the safeguarding of revenue base. We know the alternative dispute resolution program, which helped in quite collecting a number of taxes. So there's really activities. Most businesses over the last 1.5 years or 2 years have had a lot of the data analytics. The data analytics where you've had VAS, the system interrogating the input VAT that you've claimed and checking, is it really valid? And sending you statements saying you've claimed this VAT, but we can't connect it. We can't see your supplier disclosing it. We've also had upskilling of KRA officers and the intense tax audit. So there is a lot happening. There is a lot of activity at that level. There is a lot of engagement. So that's just to give us the snapshot of what is really happening within the policy front. So we want to change gear, and I want to take us through the taxes. Just a snapshot of what kind of taxes do we have? What are the compliance requirements? What are the risks? What are the pitfalls that you need to avoid as a business? I think the key one is the corporate tax, and this is really tax on profits, where in your accounting you have the profit. This is the profit that the business has made, but then the taxman has his laws, and he says you need to adjust. So there are guidelines. There are the ring fencing, there are expenses. From accounting, depreciation would be an allowable expense. But then the taxman says, no, I don't allow depreciation. I'm giving you a tax credit in form of capital allowances. We have accountants where for prudent purposes, you provide. You want to look at that expense and say, even though I've not paid this expense now, let me take it, let me capture it, so that when it incurs, then I can have my business, I can have my results properly reflected. And then you make a provision. But the taxman says, no, that's not an actual expense. Or maybe you have debtors and you're foreseeing some of the debts have really taken long and you've not collected. So you do a provision. But the taxman has come very stringent. In fact, the bad debts provision law in the Act is one of the most stringent to satisfy it, so that that expense is allowed. We know the adjustment on excess pension, then we have exchange differences. But what makes corporate income tax much more specific and unique is that there is a provision which talks of wholly and exclusively incurred. So what the law says is that the expense that you allow for your tax should be an expense that you wholly and exclusively incurred in your business. So sometimes you see companies that are regional companies, maybe with the headquarters in Kenya, and you are supporting the subsidiaries in other countries. It may be Uganda or Kenya, and you have that shared service center. If you're not earning income from that support, then there is a ground to argue that that support, the cost you are incurring, the cost that maybe group HR supporting are not actually deductible. So you need to really adjust. Okay. Yes. So we've talked. So we've talked about the tax, the need to adjust the profit and determine the taxable income. And then there's the need to file the returns. Returns need to be filed so that you are compliant. So that's just corporate income tax. I thought maybe I can just touch on some of the risk areas and some of the pitfalls before we actually go to break in some of the taxes. So when you look at corporate income tax and the regime that we are in, what we've seen is that the area of installment tax payments, the law requires you as a business when you begin a new year. So for example, you are in 2022, as a company, you are needed to pay some taxes. So if you project to make profits, then you are required to pay some taxes in portions. It's paid in 4 portions, so that before the year ends, so for example, before 2022 ends, then you will have made some portions. So this tax could be paid either based on last year. You look at last year and say, what did I pay? Do I expect to make not less than that, or what do I expect to make? So you need to ensure that the payment, you don't underpay, because the penalties are very punitive. But also with recent developments, overpaying has also become a challenge. In the past, if you overpaid, you'd just be needed to write a letter to KRA and say, I have overpaid with 3 million. Please allow me to utilize that tax in the following year. But we had a landmark ruling whereby that overpayment now needs to be audited. And that is creating new layers. So as a person in charge of managing affairs of the company, you need to really strike the right balance so that you don't overpay, you don't have huge refunds, but also you don't underpay. We've been engaging, ISPAC have also been involved, where quite a group of companies are having massive refunds with KRA. And the issue was, can't it be a simple process? If I paid over corporate tax and I have the receipts and I have the evidence, why should I go through the audit? But as I mentioned earlier, unfortunately, the tribunal ruling ruled that the commissioner may, audit, and that creates a new layer and a new hurdle. There's the issue of documentation, and for the taxman, if there's no documentation, then the expense was not incurred. I know people think that it's only the small entities that have this challenge, but we found that even multinationals, even big companies, some are moving to a shared service center, maybe it's in India or in Mauritius or South Africa, and all the documents are kept there. But the issue is, are all documents available? If KRA came, can those documents be availed immediately? Currently, I know of an SME where the entrepreneur constructed a commercial property and they engaged a contractor. This contractor was really not registered and was not filing their returns. So the building was completed. It's actually being used for business. And then the SME claimed capital allowances. And when KRA came, the documents were not there. And now there's a dispute where KRA says, we can see the building. We can see you made payment, but our law requires that we see an invoice. We see a document that is ETR, and we can't see that. So it's really a dispute which could actually been avoided. The other area of great risk that we see is separate source income. Within the law has classified some income streams into categories. So business income is under one category, rental income is a separate category, interest income category, employment income, and such like, all separately. So what the law says is that if you have a loss in one area, if you have a business income or you have a shared service center and you incur a loss, you cannot utilize that loss or offset it against the tax payable under another category. So we've seen cases, especially holding companies, where maybe they have excess funds and they have invested in a bank to earn interest, and then they receive this interest. But then the shared service center has a loss. So you find they use this loss to offset the interest. But it subjected to tax of 30%, you get 3 million. Then you take a credit of withholding tax and then pay the 1.5 million. But what is happening is they're taking this, subjecting it to 30%, then they remain with 1.5, and then they take the loss from the business and offset it. So if you are doing that, you are not paying tax. There's a liability that is actually being built. And we are seeing KRA picking this and raising assessments in quite huge assessments. The other area is tax implications during a business reorganization, where you are changing. There are so many taxes that come in. The corporate tax would come due. If you're transferring property to a third party, there will be capital gains tax. But if you are transferring it within a group, there's no tax. So very important to know those small prints. There's stamp duty, there's VAT. If you're transferring a business, there's VAT. A few years ago, if you're transferring business as a going concern, there was no VAT. But now the law has changed and there is VAT. So if you're not aware of that and just assume that because there was transfer of business as a going concern and there's no tax, then you could sit on a liability. And we are seeing that. We are seeing companies having transactions that have passed and then the liability arising, particularly on capital gains tax that was not considered. you've transferred shares that are not quoted, capital gain tax was not accounted for. Maybe you are transferring from one related party to another, or just reordering the shareholding structure. The other risk that I want to mention is just capital allowances. The law allows for some capital allowances, but then they have the categories. So you need to classify them properly. So if you have a motor vehicle, the rate is different from if you have a computer or you have a building. If you have spare parts, maybe they may not qualify for investment allowance, and that needs to be done, to be taken into account, and also the documentation. So this is just a snapshot of the risks. It is much more than this, but just to give you a flavor of what really you need to look at. So I want us to quite run through what are direct taxes and to look at a number of taxes. We have withholding tax, which is a tax where it's deducted if you are making payment to your supplier. Your supplier has provided services to you, and when you are paying, then you need to deduct withholding tax and remit this to Rwanda Revenue Authority. And then the system is built in that once you account for that withholding tax, then it immediately gets reflected in your supplier's account. And this has also become a point where KRA are just able to look at your record. So if you are a supplier, then they can look at the record and gross up and say, but you've not declared, you provided this service, but when we are looking, you've not declared the gross that is supposed to be there. We've seen this more among professionals, either architects or doctors, where when you go to their ledger, because the withholding tax was deducted, the withholding tax has been reflected, but the full gross income has not been accounted for. So on local supplies, it's 5%, but then when it's on non-residents, it's 20%. The big issue now also is that previously withholding tax, you'd only account for it when you are making payment, but now it's actually on accrual. So what this means is immediately you pick and recognize that expense, even before you've paid it, you are required to account for withholding tax. We are aware of pay as you earn and the tax that is there. If you are earning 100,000 and your employer says, I'm going to pay you 100,000, actually what will come into your account is much less than that. It will be top of the figure, about 70,000. And then there are other reliefs, such as insurance relief, that sometimes most people are not taking advantage of. If you have a life insurance that meets certain criteria, then that relief is available up to a maximum of 60,000 per year. So that can actually reduce the tax liability. I've talked about capital gains tax, which is on transfer of land, buildings, and shares that are not listed in Nairobi Stock Exchange. The rate is 5%. But here the definition looks very simple until the transactions come in. And there's massive challenges. If you look at the law, there are a few gray areas. For example, if you transfer shares that are held in an entity in Uganda, should I really account for capital gains tax or not? But there are also exemptions. If there is a reorganization within a group, then there is the exemption. We've heard of minimum tax, which was a tax that was introduced by the government from last year, effective 1st January. I know this is a subject of a court case where some traders went to court. I think it's at a high court now, but it's accounted for at 1% of gross turnover. So you look at what installment tax based on prior year that I am paying this year. And then you do 1% of gross tax. So what this means is that even where you are in a loss position, then you'll be required to pay the tax. We are aware of the turnover tax, which is on 1% of gross turnover, and it captures the threshold of 1 million to 50 million. So this was targeted at SMEs, excuse. And then there are a few exemptions. So if you are dealing with rental income, management fees, or professional fees, training or employment income is excluded. And these are just part of those reforms that I was talking about. The government trying to make it easier, target the informal sector to ensure that everybody is brought into the net. I talked earlier about digital services tax, which was aimed at taxing income derived and accruing in Kenya. And a number of multinationals have actually registered. From the effective date of last year, most multinationals are now paying the digital tax. And what the government is saying is that you are based outside Kenya, you are based in the UK, you are based in Ireland, but with your platform, you provided a digital platform that sellers and buyers can meet. And you are collecting income, you're collecting revenue from Kenya. We need a portion of that revenue. We need a portion of that revenue. So most have registered, some have appointed tax representatives to assist them. And it's an area that we've also really assisted a number of clients. We have compensating tax, which is now also one of very complicated tax that we have. But what this looks at is when we're declaring dividends, have you declared dividends out of untaxed profits? Because sometimes we've seen businesses where, because you claimed capital allowances, if you have a huge investment, the law will allow you a capital allowance that is significant at 50%. So business may be doing well, you have cash reserves, but when you do your adjustable taxable income, what I talked about, you are in a loss position. So you are not paying tax. You are not paying tax. But then when you look, when the stakeholders are looking at you look at your account, you find you have tax. I mean, you have cash, and you can declare dividends. And then in the law, there's what we call dividend tax account that is maintained. So depending on if that dividend tax account shows a positive, then you will be, you'll find that you are needed to pay tax. The other one is an interesting one, and this came in 1st January 2017. It may be one that most of us are familiar with, and this is withholding tax on rental income. So the government introduced 10% on gross rental income. The threshold is the rental income should be between 288 to 15 million. So if you are falling within that category, you account for this, and then you've paid your tax. Over the weekend, I traveled to Kitale. We had lost a niece, and I was talking with my uncle, and he gave me a very interesting story. In fact, I just wondered how KRA has become sophisticated. He said, you know what? KRA called me and said, you have a PIN, why are you not filing returns? And then they told me, we can say you have 3 electricity meters. We believe you can't be living at three places at the same time, unless you are polygamous, but even then, we need evidence. So he actually had to go to the Revenue Authority. This is in Nakuru. And from there, he could not explain the other 2. So they discovered that actually he has rental income. So he tells me, we reached a gentleman's agreement, and every month, once I get my money, I pay and I'm safe with them. But it just shows the sophistication that KRA is having. We know actually mapping the titles and mapping at landlords so that they narrow the gap. But this was just, again, one of the ways of expanding the tax bracket and widening the tax base. So that's all about direct taxes. Let me quickly jump to indirect tax. I will go a bit speed because I'm seeing the time. But then we have the VAT. And VAT is known, it's a tax on services. The threshold is if you are having taxable supplies of 5 million, then you are required to register. We know the rate is 14% of the rate, that's the rate of tax. So the VAT works by exception. So we have a number of rates. So we have standard rated VAT. So that is goods and services subject to VAT at 14%. Then we have reduced rate, which is 8%, the petroleum products. We have 0 rated, and then we have exempt. So when you look at VAT law, we have 100% list of what is exempt. And then we have 100% list of what is 0 rated supplies. So if you have a product, so assuming I'm selling clothes, Nelson is selling clothes importing from China, I look at the exempt schedule. If clothes is not listed there, then I know it's not exempt. And then I'll come to zero rated. If it's not there, then I know it's not zero rated. So I can safely conclude that this is subject to VAT at 14%. So that's how it works. We have an input-output system. Sales on VAT on your supplies and sales, you charge VAT, which is output, and then your expenses is input. And then if you are in a payable, then you pay the VAT. I think the big news on VAT is what KRA is doing. Most of us have heard of Teams. And what Teams is intended to do is to connect taxpayers' ERP with the KRA system, such that going forward, when you issue an invoice, it will immediately be reflected in KRA's server. And then, so what will happen is that even the returns will be pre-populated. So when you go to do the return, the information will already be there. So if you're adding more information, it will be a question of why was this not included? The same case for input VAT. When your customers claim the VAT, if you charge them the VAT, then it will go directly into their system. So it's a very integrated approach, and it's working. Actually, it's very interesting because when I was in Rwanda, by 2016, they'd already introduced this, such that sometimes if you're operating and your system is off, you'd find the Revenue Authority calling you and saying, why is your system off? So it's not anything new. Kenya is starting, but it's expected that it's really going to revolutionize. It's going to reduce non-compliance, and it's just going to make compliance much more critical and important. The deadline to comply is 1st August 2022. So not much time is left. We have withholding VAT, where in an attempt to actually get the VAT ahead, suppliers are required to withhold to 20%. I mean, the customers, when they are paying their suppliers, and then remit this to the Revenue Authority. And this came many years ago, actually before 2010, and it was credited with reducing that non-compliance. Because what would happen is your customers will deduct this and remit to KRA, and KRA would immediately be able to see and say, but we are getting this VAT, but we are not getting this return. What is really happening? So we have the withholding VAT system. The system works automatically. When you look at the ledger, then that will be reflected. Just quickly to run down across other taxes. Brian, I hope we are fine. I know tax is normally taxing, but as the CEO said in his opening remarks, it's very important. It's very important.
We are fine.
Okay, thank you. So we will go through excess duty. This is applicable on goods supplied in Kenya and a number of services. Currently, you are aware that there was intention to increase the excess duty, and some taxpayers went to court to challenge the proposed increase of excess duty on petroleum products. Because what was happening is that because of the move of petroleum prices, the government wanted to adjust the rate. So there's really a court case which is waiting to be determined. So what happened is that the government increased excess duty on other products, but petroleum is still held. But it's really interesting because I was reading a news yesterday that despite this and despite petroleum, which they were expecting to collect more, the government still met their target for I think the October-December collection. 58 billion was targeted, was the target, and they have collected over 60 billion, I think 65 billion. We have customs duty, which this is interesting because within East African area, we use one law called ICMA, and that's the law that all the 3 East African countries use. We have only 3 rates, 0% for raw materials, 10% for intermediate goods, and 25% for finished goods. There are within this law some exemptions, some other reliefs for traders, which are included there. But for some of us, if you've imported a car, then you've bared this cost. We also have railway development levy. This is charged at a rate of 2% of customs value for all goods imported into Kenya. We have the import declaration fee. So the IDF is charged at 3.5% of the value of goods. So quite the direct tax, the indirect tax, and we can see the number of taxes. And as I mentioned, this is just a high level. So we have an appreciation of the taxes that we have. So just quickly to look at some of the risk areas before we finish with the last 2 slides. We have within the VAT, we have what is called blocked items. So although you are allowed to claim the input VAT, there are some VAT that you are not allowed to claim. So for example, if you have passenger cars, private cars, even if you're using them for business, that VAT that you can count repairs and maintenance is not deductible, unless you are like Toyota Kenya Limited, who are selling cars. But even then, they can only claim on the cars that they are selling, not on the cars that they are using as part of the business for business part. This is one risk area that we have seen that businesses miss out. And it's always very easy for KRA once they come to audit and they pick, you are collecting this through data analytics, they go through your system, they analyze, format, and then pick all these suppliers and disallow that, and then that becomes a liability. We've also seen incorrect VAT treatment. Interestingly, in quite a number of cases where a business is trading, they have items that should attract VAT, but they have not accounted for VAT. An interesting case is sometimes we've found businesses that they came in, they set up as an SME, they have grown to become big, but you find all through, they are actually having exempt supplies, but they are charging VAT. So when they realize it's quite late, because they're charging VAT and they're not supposed to charge VAT, so they're charging input VAT. And when that is discovered, then they're required to amend their returns. And if you are exempt supply, then the input VAT is not claimable. So if they showed probably a refund, then that refund is not valid. Or if they paid VAT, then there's also the task of how do I get that VAT back? We have VAT on personal use. Maybe you are in a business and you've incurred VAT on personal use or on your personal expenditure. That is not blocked. But we see sometimes some of these really getting into the system. Or you've incurred it on staff costs, entertainment that within the law is not allowed if it is entertainment. For example, you are in Nairobi and you incur accommodation, then the law does not allow that. If it's outside workstation, then it's allowed. So there are the fine prints that Murithi talked to us about, the fine prints that as a business you need to look at. There's also the apportionment of VAT. If you're dealing with the taxable supplies that are subject to VAT, and you have exempt supplies, then you can't claim all the VAT. But we see a lapse where businesses are not apportioning. And then when the apportionment comes in, you find that they underpaid the VAT. If you're dealing in a business and you have exempt supplies, and then you have items that are subject to VAT. If you are exempt business, or maybe you are dealing with vegetables which are exempt, or you are dealing with exempt products, and it's more than 10% of your turnover, then you are not allowed to claim the full VAT. So if you don't do this apportionment, that VAT that you are claiming is overstated. We talked about the documentation? Do you have the invoices that you're claiming VAT on? Do you have the credit notes? Do you have the ETR machine? Do you have the contracts? Do you have the supporting? Can you support that expense? And again, it may look very easy, but I can tell you the reality is that sometimes when KRA comes to audit 4 years down the road, getting those documents becomes a challenge. A more common one that KRA focuses on is now reconciliation, where they look at your VAT returns and they say, okay, in your returns, the whole year you've declared 10 million. But when we look at your turnover, you have declared 15 million. So what is this 15 million? Is it exempt? Is it outside the scope of VAT? If you can't explain, they charge that, they subject it to VAT. And vice versa, if you have 10 million and in your turnover, you've declared 8 million, then the 2 million, there's an argument that you've understated your corporate income tax. So again, these are just a snapshot of the risk areas. I want now to touch on a few topical issues, but I felt that before I touch on them, areas that deal with the exemptions, with the assessments, I can just give us a snapshot of the assessment and objection process. Of course, in the experience, and we've had major court cases, they've made it to the news. We've had taxpayers challenging KRA. Recently, we had a case where the amounts involved were quite significant. It went up to high court level, and KRA was expecting to collect some amount, but it was ruled in favor of the taxpayer. Just now, we've had a very interesting ruling where the court has ruled that the regulations, the VAT regulations, were not enacted properly. So throwing it off, and it's really confusion now. So within the law, there is a dispute resolution process. So KRA will issue an assessment. They will come and do an audit, and then they will issue an assessment. And the audit management process, how do you manage this audit? It's a whole subject altogether, which again, if we were to do a training on it, it takes almost a half a day. How do you deal with KRA? When they come, how are you liaising with them? How are you managing the audit? So they will issue an assessment. You will have 30 days to file a notice of objection. KRA then will have 60 days to revert to you. But if they ask for additional information, then the 60 days are triggered. So that's why we've seen cases where some appeal process or objection process has really taken a long time. If there is no agreement or settlement, there's a next level to the tax appeal tribunal, where you file a notice within 30 days from the date of the decision. And then after that, the taxpayer has 14 days to file a statement of facts and a memorandum of appeal. KRA then has 30 days to file that statement of facts. Then the tribunal will hear, they'll give a date, parties will meet. In the meeting, sometimes you can opt to go through the alternative dispute resolution process. So it's similar to an amicable settlement, a meeting where you engage this and try to really settle. Then a judgment will be issued. If there is no agreement, then there are other levels, the High Court, the Court of Appeal, and lastly, the Supreme Court. So it's quite given. There's room for taxpayers to appeal. There's quite a process, but it really takes time. You can see everything is hinged on dates. So if you miss dates, then an assessment can be confirmed. And actually, we've seen cases of taxpayers coming late and saying, there was this assessment, it was lodged in my iTax ledger, I've not checked my iTax ledger, and I've not appealed. Can you try to do a late appeal? And when you are doing a late appeal, then you are at mercy of KRA. So these dates are there, but very, very critical. Sometimes it may indicate that it's 30 days. If there's no preparation for the case, you find you are not prepared because you've started late. So quite a number of areas. Quickly, as we go towards the end, so some of the topical issues is just huge assessments. We've seen KRA issuing assessments. the audit, their audit team. Kenya Revenue Authority since probably 2003, 2004 when I became a manager, a tax manager. And I can tell you I've seen quite a huge progress. When I went to Rwanda in 2010, the audit team in Rwanda, the audit was very cumbersome. What they would do is they would ask for all your bank statements and start scrutinizing it and pick any credit they are saying it's income. And that was quite time consuming. And part of what we did as PwC is just to convince them to go the risk-based approach. And from the conversations, it actually went well. We got a contract to engage with them. And I can tell you now, when I look at even the officers there, there's a lot of progress. So at KRA, the assessments will be issued. If you don't respond quickly, it will be confirmed. And then we've looked at the dispute resolution process. But unfortunately, sometimes we've seen KRA ignoring and issuing assessment agency notices, which is the second bullet, even before this is exhausted, where the appeal process is still there. Unfortunately, from our experience, we've seen the tribunal coming to give relief to the parties. We've seen cases where KRA are going to your customers and writing to them and saying, you owe this taxpayer the money. Please remit that money to us because they owe us. And when you look at the law, then they have the power. They have the power to actually engage and do that. They have sometimes appointed a tax representative. So we've seen all manner, and the space is quite active. We've seen businesses that never put their affairs in order, and the tax demand are threatening to cripple them. I remember when I was in Rwanda and even here, sometimes some of the assessments can be really huge when you add penalties and interest. And the message today is just that as taxpayers, are you really taking well? Are you looking at your affairs? Are you looking at the iTax ledger, which is the next box? Because sometimes KRA raises an assessment and it goes into a ledger. It offsets the refund that is there. And if you don't check, you will not know. Or you are engaging and they have disallowed some input VAT and they raise an assessment which it's into a ledger. So you need to constantly check your ledger. What we find out is that most tenders nowadays require tax compliance certificate. So it's important that your records are put in order. The good news is that with the alternative dispute resolution, we've seen a lot of cases sorted and settled at that level, where it becomes a win-win situation for the taxpayer and also for KRA. And our team, we have a whole legal team here that deals with the tax controversy and dispute resolution. We've supported quite a number of clients. I know that's an area that most people have experienced challenges, and I expect comments or questions on that. And now to go to my last slide, and this is 5 habitual tax mistakes that companies make. About a few years ago, I wrote an article on 5 habitual tax mistakes that companies wrote in Rwanda, and it was actually very well received. On that day, it trended as the most top read article. And it's because of how in Rwanda, the revenue authority is aggressive. Actually, they close businesses. They come, the demand, the laws are very stringent. And then they don't have a room for waiver of tax. If you have a tax liability, for it to be completely waived, it has to go to the minister cabinet for approval. And that's a very great hurdle. So businesses take tax seriously. I know in Kenya as well now, businesses are realizing that tax is actually very key. So one of the areas is not being proactive on tax matters and waiting until the assessment has come in. The CEO talked of the need to involve professionals. I think when you involve professionals, it's taking an active step. That's the number two, managing risk without professional help. Tax is complicated. Tax is complex. I have seen. I had a friend who is a doctor managing business, and they operated. And for a whole year, they never knew that out of the supplies that they make, one of it is actually subject to VAT, because it's very obvious. Always you think medical is exempt, but there was small print that there was the spectacles that they share was not there. And when they discovered, I'm glad that they have worked with the Revenue Authority to manage the process, but that's how the risk can come. Earlier on, I talked about the SME that is now facing a huge investment allowance that KRA threatened to disallow. But because they thought it's simple, tax is not accounting. Tax is actually quite complicated. Some of the businesses lack a roadmap for managing tax risk. As a business, you need to have a tax risk management framework. And what this needs is you need to look at what are the threshold of my expenses. If I'm incurring an expense of maybe 1 million, before I approve it, should I, as part of the approval process, as the management team, do I have a paper analyzing the tax exposure, so tax risk? If I'm introducing a product, am I actually having a tax report that tells me that we've looked and the VAT impact is this, or the withholding VAT, or the tax impact? We've seen cases where the procurement are evaluating various tenders, and you have this service provider who says, for me, this is my consolidated cost. Pay me this, I'll take care of my accommodation, I'll take care of my travel, I'll take care of my other expenses. But there's another one who maybe charges less, but says, do this is my cost, but you have to take care of my flight, you have to take care of my travel, you have to take care of my service cost. So what is really the tax impact? What will be the base for withholding tax? When you are paying them, assuming they are non-residents, and you are paying them, what would really be the tax base? So it's important to have a policy of saying, if I'm engaging in this project, do I have an analysis that confirms to me that we've looked at the tax issues and we found it that it's proper. We found that the tax is proper and that there is no tax obligations. We've seen cases where businesses introduced a product, there was no analysis on the VAT implications, and the product is in the market 3-4 months. Before then, the tax people pick and say, but we should be charging VAT. So there's an issue of backdating and charging VAT. Number 4 is just failure to involve key stakeholders, such as the CEO, CFO, and board committee, tax advisors, or legal advisors. So tax officers are left alone, but they lack authority to access key areas of business to provide the required input. Maybe you are having that transaction. There should be a way where a tax resource can be trusted from a confidential basis to give you a snapshot of what are the tax implications. A CGT of 5% on a transaction can be quite significant. VAT of 14% on a transfer of a property can be significant depending on the transfer. And sometimes the businesses are aware that yes, this VAT of 14%, that's well and good, and the finance team know about that. Sorry. But then there are issues called tax points. Where is it triggered? So sometimes you find this transaction began, for example, last year. There have been some payments, but VAT was not accounted for. So when it's concluded, it's when now the team comes and says, we are concluding this transaction. What are the tax implications? You look at the agreement, you find the tax point was triggered last year. So when there's a teamwork, when there's that engagement, then this can be addressed. The other aspect is lack of communication between tax team and rest of business. This is largely tied to number 4. We know tax managers only largely focus on processing returns. They want to ensure is PYE filed, is corporate income tax filed, have I filed withholding tax, have I filed excise returns, have we accounted for customs duty, has the agent helped us do that? But the research done, and this has been done severally, shows that just focusing on the transactional aspect only covers 40% of total tax risks in business. The majority of it requires the conversation, requires the proper understanding of what is happening in the business. What is happening in the business? What are we changing? What are we changing in the business, and what is the tax implication? What are the other benefits that we are providing to our employees? What is the tax implication? What are we doing in terms of this transaction? Yes, we have this supplier coming to install a software for us, an ERP software. What are the tax implications? And just a constant conversation where there's a way that the tax team can have the appreciation of the whole business. Sometimes you find the system is mapped such that for VAT, it's able to pick some codes. But then what about the other income? If the business sells some income, and this is not picked within those codes, then how will the tax manager know? And in reality, we find significant gaps where the tax manager is not really having access to the information, or they are not involved in the business. So I think it's important just for to manage tax. We've seen cases where the shareholders were very happy and declared dividends because the month ended and there was that profit. But then when the audit is done, you find there were gaps. And then the liability actually means that what was taken to retained earnings or what was taken as profit after tax was actually overstated because in essence, the tax was not paid. So just I thought I can just give us a snapshot, run us through what are the various taxes. I've tried to capture every tax, both from direct tax perspective and also the indirect tax. We've looked at what are the risk areas. Documentation, of course, hinges very high in terms of just ensuring your documentation is okay. But again, the other message we are saying is that tax resource, the tax team, incorporate them so that they are able to get the right information. What is happening in the business? Let the business discuss it. Let's evaluate the tax implications. As part of the approval process, demand that the tax analysis is included. And as a business, you can have thresholds, maybe for 1 million, 10 million, depending on the company, whereby that tax analysis and its implications will need to be captured there. We've talked about VAT and what is coming in through teams. That's a big one. Businesses need to be prepared. If the nature of business is unique and implementing that teams will be a challenge, it's time to engage Kenya Revenue Authority and see what are the solutions, what needs to be done. We've talked about the policy direction of the government, how the government is really intent on widening the tax base. We've touched on the voluntary tax disclosure program, which is still available. This year it's actually 50%, and then next year it reduces to 25%. But these are opportunities that businesses can take advantage of. So that's really the presentation, Brian. I just wanted to capture the highlights because, as I mentioned earlier, tax is actually very, very wide. For VAT only, we actually do it for a whole day. But even the whole day, once you finish, you still feel a lot is left and you've not concluded everything. Corporate tax also will take a whole day. So this is almost just scratching the surface. When we talk about the risks, again, we can actually do half a day. So you find tax will need almost 4 days to cover it exhaustively, but we've tried to synthesize this within an hour. But the points that were made earlier when I was being invited is that you don't really joke with the tax. It requires really proper management. And today on this talk, because I didn't know the forum CEO, I avoided the scaring cases. I don't know whether I needed to do that, but there are quite scaring cases where you find really there's clear lapse and there's no way out, but people ignored. Business grew, changed form. Everything else was looked at, the governance was looked at, but tax was given a backseat. And then the outcome becomes quite very expensive. So I want to sign off at that level. I hope I've communicated to the audience. I actually acknowledge that tax sometimes is not one of those very friendly topics. Some people say very taxing or to something new that you are not aware of. So over to you, Brian.
Thank you very much, Nelson, for that presentation. Surely tax is a complex subject area, as you've stated, but you've done justice to the presentation. Very detailed presentation, in depth, and you've given us new knowledge. Many were not accustomed to this kind of knowledge, but we are very thankful for the presentation. You've done justice to the topic, demystifying tax and pitfalls to avoid. We really appreciate. I think at this stage we move over to the question and answer session. I will float some of the questions that are coming in through the chat box. Members, please feel free to type in your questions in the chat box. Then we will endeavor to have all those questions answered by the speaker for the day. I think I'll start off the first question that seeks a clarification on, there's a statement that you have made that tax is not accounting. So there's some need for you to elaborate on that statement. That tax is not accounting. I think we can take that one first, then we progress. But we truly appreciate, I've taken keen interest on the topic, and I've seen truly tax is taxing. I think I address the first question, then I'll give you the next two questions. Thank you, Nelson.
Thank you very much, Brian. I think that statement, what I meant is that we've seen cases where finance professionals work to try to advise on tax without having had the knowledge. So we have cases where we have finance professionals, but they have also upskilled themselves on tax. So that's okay. But we have a case where what happens is that you'd find a transaction, one wants to look at an expense from an accounting perspective. They say, but why are you not allowing this expense? Why are you not allowing this expense? And yet it's expense, and I can I've had quite arguments and discussions with taxpayers or just companies. But what I meant is that the tax has its own laws. There's a whole comprehensive law of tax where certain items are dealt. So that distinction of being aware that although we use the framework of accounting, we start from profit before tax. So the basis is actually accounting, but after that, then we adjust. So you have accounting profit, then you have taxable income. So that's what I meant, that it's important for businesses to appreciate that within tax, there are tax laws. So if you don't do anything according to the tax laws, then you are likely to have a challenge. So for example, the issue of withholding tax, where the law now requires you to account for withholding tax on an accrual basis. But I mean, as an accountant, you feel I'll have that pinch when I pay the expense. But the taxman says, can you pay me before you've paid the expense? So those are the distinctions that are needed. There are complicated adjustments like IFRS 16, where you find an accountant or dealt with it in a different way, but then the taxman wants you now to readjust. So I don't know whether that statement, the way I made it, explains that, but that's what I can clarify.
That is okay. Thank you for the clarification. I'll float the second question that states, are there any taxes involved when one changes their business headquarters, especially if they are housed by another legal entity? What would be the tax implications of such a move?
I think we just need clarity whether it's changing from locally, if they're resident, or they're non-resident. But I can deal with it both ways. So if it's within Kenya and you change your headquarters, maybe you change your headquarters locally, what will be looked at is what are the transaction flows, what is really changing. If you're changing your headquarters, let's assume you are changing your headquarters from Kenya to a different country, then what are the associated costs? Are there any expenses? Will there be any recharges? So those are the type of transactions that the tax will pick. As I've been growing as a tax professional, there's a term that we constantly use, and that term is that every transaction has a tax consequence. So you can't just look at it in isolation in terms of, if I change my headquarters, are there tax implications? But you have to look at, what does all this mean? If I'm changing, what is really moving? Am I moving some business functions? If I'm moving some business functions, then what are the expenses that would really be flowing through? Will there now be recharges to a different country? Then if there are recharges, there are withholding tax, there's transfer pricing, there are different rates. So it's really a big issue that one would need to understand the full context, not just merely on changing.
Okay, that is well noted, and I think I'll take one of the statements that you've made there. Every transaction has a tax consequence. I think that's very, very important to note. Then I'll give you the.
Hi, Brian. Just to add something, I think again we're changing and maybe moving into low tax jurisdiction, such as Mauritius. We have tax-free areas. Then you look at what are really the incentives that you are going to enjoy there. So it can't be looked just in isolation. It's a whole looking at it in totality. And it's a whole aspect of advice to look at the implications and whether that move really is tax optimal.
Thank you for that additional clarification. The last question that has come in is on the tax grace period requirement. That is 100% waiver of interest and penalties. Does it apply to all businesses or only those who do self-declaration?
I think, Brian, that's really a good question. I want to clarify that, the government introduced the voluntary tax disclosure program, and they'd given a period. So it was to cover the period 2015 to date. And it was hinged largely on voluntary disclosure, where you go to KRA and say that I want to disclose this tax. So it was staggered. So the first year, which was last year, the waiver was 100%. So that is now gone. It's passed. So when coming now, we are on the second year. So the waiver now is 50%, but it's hinged on voluntary. going to KRA. They'd excluded certain areas. If you are under an audit, then you can't utilize that. But we've seen cases where if the audit had not advanced significantly, then it was possible to engage KRA and agree a good platform to begin in. So it's actually based on declaration and voluntary disclosure.
Thank you very much, Nelson. I think that is the last question that has come in. And at this stage, I would want to invite Dr. Murithi Ndegwa to give us the closing remarks and close off the webinar. Karibu, Edie.
Thank you very much, Brian, and thank you so much, Nelson. I think this, like you rightly said, perhaps is a topic that requires not just 4 days, maybe a whole week, because there's really so much heavy lifting that we've gone through within the short time that we've gone through. But I can honestly say that we've learned quite a lot. And when I speak for myself, there are so many insights that we've gotten from your presentation. Allow me to say thank you to every one of us who attended this webinar today, those who attended right from the word go, those who raised questions, those who are attending from the first time. I think I saw somebody who was participating from Rwanda, and even those who logged in on time. Thank you very much to all of you. Please remember that we always have this kind of webinars after 2 weeks. That means the next one will be next week, but one on Thursday, same time, 3 to 5 o'clock. We also want to appreciate the members. And we posted something on the chat where we said, if there's any topical area that you'd want us to get a discussant, please feel free, let us know, and we'll endeavor to get a great presenter just like Nelson on any topical issue that you'd want us to discuss. And to our speaker of today, Nelson Ogara, thank you so much. I've just sampled a few of the comments on the chat. There is one person who said a great presentation. I think there's another one who said very insightful. And we say, thank you very much, Nelson, for this great presentation. You have given us a very good discourse on demystifying tax. And I think it is important that we take note that perhaps we may need to call you again for purposes of expounding a little bit more on some of the areas that you didn't have time to cover. But Nelson, thank you so much. We really appreciate your time. We appreciate also the presentation, and we also appreciate the time that you took to prepare for this, despite the fact that I know you must be quite busy at PwC. And we say, thank you very much. Pass our warm regards to everyone, and to everyone who participated today in today's webinar. Thank you very much. Have a blessed evening and keep well. And Mr. Nelson Ogara, thank you so much. And have a blessed evening, everyone. Thank you.
Thank you very much.